Hi, Jim Gore from Thor Investment Management. Last week was a very bad week where the market dropped almost 5%. This is normal. As a matter of fact, the last 2 years is the first time that we haven't had a 5% correction in over 100 years. But what's most important is to make sure that your portfolio is diversified. We've been talking about here at Thor that we are diversified. We have the lowest exposure to U.S. company stocks, and we have a low exposure to equities. When we are invested in equities, we are overweight things like emerging markets. But why are we invested in emerging markets? Let's look at the figures. If you look at the first statistics, the first three, the CAPE ratio, price to book, and price to sales, you can see that the United States is selling for almost twice the valuation of emerging markets. But the column all the way on the right, if you look at the dividend, this is what is very surprising. This is a beam me up moment. The dividend yield of U.S. stocks of the S&P 500 is 1.8% versus 2.7% for that for emerging markets. Why is this important? We are buying assets that should grow faster in the United States at a cheaper price with a higher dividend yield. Over time, what this means is that emerging markets should outperform U.S. stocks. That is why it's an investment. You look over time, not what happens on a daily or weekly basis. So over the next several years, we would expect emerging markets to significantly outperform U.S. large company stocks.